Welcome back. There's another look at U.S. futures, a very even pace of advances across the three major U.S. equity futures contracts, suggesting U.S. markets may bounce back somewhat following yesterday's huge sell-off in which the NASDAQ composite ended the day down 3.5%. There's a look at the NASDAQ, and you can see that dramatic plunge at 2 p.m. Eastern time. That's exactly when the Fed released its statement. Despite the current volatility, our next guest is bullish on U.S. markets and expects to see the S&P 500, which also plunged yesterday. You can see its return over the past year is 24%. It was down 3% yesterday. He expects to see the S&P 500 gain about 12% in value over the year ahead. Dec Mullarkey is Managing Director of Investment Strategy and Asset Allocation at SLC Management. Dec, thanks a lot for joining us. It sounds like you are not concerned about the statement of the Fed yesterday. You don't think this has fundamentally changed the outlook for stocks in 2025.
Good morning, Paul. Great to be with you. That certainly is a fair assessment of where I'm at. I mean, my takeaway from yesterday, and just as you mentioned, the markets are opening up pretty strong today. Is not to be discounted. The market did react, but I think what markets are doing right now, and Powell's statement and his guidance kind of, led to this. Okay, fewer cuts next year, but I think there's also a higher probability that you could actually have a rate hike. And there's a lot of noise around, okay, what's going to happen with policy, but the economy is running very strong. It has, you've got a situation where the Fed has done a lot, but at this point or other, inflation looks sticky. So they could be in a bind as to whether they can move. Now, the thing that's relevant always for equities is what is the growth outlook? And the growth outlook is strong, both in terms of the economy and in earnings, particularly for large cap. Small cap are a little different, and that's one area where I'd be concerned, and it'd be interesting to see how they bounce back today. I think they're a little more vulnerable, but broadly, large cap positive on where they're heading next year.
I'm interested in that caution you've got on small cap stocks. One of the big narratives we've heard for a while since the Fed began reducing rates, in fact, since the time it was expected to begin reducing rates, is that small caps are among the chief beneficiaries of lower rates. Among other things, their financing costs come down. Why are you concerned now about the future for small caps? Are you suggesting that if rates aren't coming down as much as markets had earlier believed, that there could be some spillover there to the small caps?
That's certainly part of it. But the other more fundamental issue is that small caps and, to less of an extent mid caps, but small caps in particular, their earnings have not recovered. They're still, the earnings outlook is not great. In fact, it's that they'll probably be flat to where they were this year. And that's not great going into a period where there's going to be some uncertainty around trade and the tariffs and what happens with that. That's where I think that they have fewer levers to pull versus large cap. Tax breaks certainly will be a big positive for them, but it'll come down to that trade-off of to how they may be affected by tariffs and what's happening there. And they certainly are more domestically focused, so that's a positive for them. But I think there is some balance there, and I do think, or balance of risk there, and I think the large cap are just better hedged at this point against some of those, if you will, uncertainties that are hanging over the market and will play into next year.
A lot of attention on the Trump administration, of course, and what is seen as a pro-growth administration. Some of his cabinet selections are eccentric and controversial. Others are more mainstream. And I've seen in some of your recent notes that I think you look favorably on nominations like Howard Lutnick as his pick for Secretary of Commerce, Scott Bessent as his Treasury Secretary nominee, and Chris Wright, his nominee for the energy file, correct?
That's correct. That's correct. I mean, that's one of the areas, when you're trying to handicap any of these policy statements that politicians make on the campaign trail, you're trying to figure out, okay, how much of this is tangibly going to flow through? These promises, all this rhetoric, And so at this point or other, until we actually see those rolled out, it's hard to tell. But the picks, the nominees, that's an important indicator of where this may head. And there you've got, in those three folks you mentioned, these are Wall Street veterans. They've had a lot of experience. They understand markets, and therefore, in my view, is that they will push back against something that they think is going to disrupt markets. The other positive, in many respects, is that President-elect Trump is very, very are aware of markets, and he will point to a stock market as a real-time indicator of how he is performing. And that's another area where I think he is very tuned into looking at financial performance, particularly across the stock market, as a real-time indicator of how he's doing. So I think that is a constraint as well.